Good afternoon, students. Welcome back. So today we are going to start with this new topic, which is about materiality, risk assessment, and internal control. As you can see, uh, this chapter, particularly if you look at this chapter, this is quite comprehensive, and there are reasons around it. So the topics are such that one, they cover the aspect related to the planning. Further, they are extremely important when it comes to the audit of the financial statements, because currently, if you talk about the way the audit is required to be performed, okay, and I think we have had some discussions around the audit planning in particularly. In the previous session as well, we talked about this audit planning. Now, when you talk about such audit planning, so we can say the key element, or you can say the most important element of such audit planning happens to be what? The risk assessment. So that's why this topic anyways happens to be extremely important. Now, if you look at the practical aspects around this risk assessment, the way the companies will do this, or any entity, you'll see when I talk about the company, it's more from the audit side. So there again, you find that the application of this particular area is quite focused upon. Why? Because as we have discussed, everything comes down to the planning. So it's basically the planning which will drive the entire audit process. So anything that you miss out at the planning stage, or maybe during the planning, whether you are planning that initially or maybe you are updating that at any stage, eventually that is required to be brought down at some place. Otherwise, what will happen? Otherwise, you'll see some sort of challenges coming up. Okay, and that is going to impact the overall audit quality. Why? Because if the process is not right, so what will happen to the outcome? Yeah. So automatically you see the quality going down because of that. So that is where this topic becomes all the more important. Correct. Now, materiality is again another area. I'll touch upon this materiality a bit later. So to begin with, what do? We'll start with this risk assessment. And while talking about this risk assessment, we'll try to understand, first of all, what exactly do we do when it comes to the risk assessment. Okay. Further, in respect of such risk assessment, anything which is required to be looked at, anything which is required to be taken care of. So how do we really go about it? Okay. So that's the second aspect we are going to cover. Further, when it comes to the risk assessment, it will also be important, I think, to understand that, okay, we are talking about risk assessment, but where do you actually need that? Yes or no? Because there may be a thought process, there may be a consideration as to where exactly do you require that. So we'll also now try to understand as to, where do we need that? Where is that actually required to be considered? Right. So some of these aspects we'll try to discuss. Okay. Now, what I'll do now is I'll just share one document with you. Okay, which is more about this entire approach and something that we have been discussing in the previous sessions as well. So you can say we'll sort of continue on that part briefly. So now, if we go back to the discussion we had in the previous session as well. Okay, so what I'm doing is I'm just sharing the document. So when we were talking about planning, yeah. So we discussed that there will be a planning meeting. In the planning meeting, what will the auditor do? Obtain the understanding. And wherever the auditor has got the understanding, means it's a continuing engagement. He already knows the business, he already knows the processes, the contracts, the transactions. Therein, the objective will be to update the understanding. Okay, so we will move on to updating the understanding in such a case, right? Now, once you do that, what is the next stage you will get to? Risk assessment. Now, what do you mean by this risk assessment? Okay, now this is the one that we discussed last time now. So now we are going to get into the details of this risk assessment. Now when it comes to the risk assessment, where does the auditor really need this? Now, if you talk about any company today, small, medium, large, you will see voluminous data being processed. You will see significant number of transactions will be there, maybe running into thousands, lakhs, again depending on the size of organization that you may have. Now in such a case, as an auditor, we also understand that audit has some inherent limitations. Yes or no? Yeah, so one, when you talk about the audit, so will you be able to check everything 100%? Answer is no. No, not really. And even if you check few things, okay, so you're not checking, let's suppose, a certain part of the population. So let's suppose this is the population that you have. This is what you have tested. Okay, what about the remaining? Now, remaining one, you are saying that that's the approach, and that's how the audit is required to be done. So that's an inherent limitation. Okay. Then comes the point that how do you choose what to check? Correct. So some of these things we are going to check. How do you really choose that? How do you really reach that? Okay. Yeah, so that's the thought process which may again arise. How do you really go about it? Now that is where risk assessment comes into the picture. So we may say that if let's suppose you were to check something and you know that everything is not possible. Everything is not possible for you to check. So how do you really go about it? What do you do in such a case? Yes or no? So what do you do? How do you really go about it? So in such a case, what will happen is you will find a mechanism wherein you will segregate the entire work into two parts. And then that's something you actually do in respect of your day-to-day activities also. something which is more important and something which is not so important. Now, same goes over here. There are two buckets. One that you call as significant risk. Second, that you call as not so significant risks. Now, in this case, what will happen? Very simply, the areas which you consider as the risky areas, or the ones involving significant risk, that's where the auditor will want to focus more. Yes or no? Yeah. So you can say the extent of testing will be higher in respect of what? This particular category. Yeah. Now someone may ask, but what is this risk when it comes to the audit, or when you talk about this risk assessment? So what actually do we mean by this terminology risk? Now, so this question may arise. Now, what is risk? Let's look at this part. See, in relation to any activity that we do, any transaction which could be there, what can happen? Something may go wrong. Yeah, so you may say that. So it's not a mandate. You can't say that it's necessarily going to happen, but there's a possibility. Yeah, possibility is something may go wrong. So now, what is it that can go wrong? That's what the management will first of all look at. What can go wrong? Right? And once, let's suppose that is identified. So say management has identified this. What will the management do as a next step? Against this, they will bring in the controls. Correct? So why do you bring in the controls? What's the purpose? Okay, how does it really help? Very simply, to ensure that this, what can go wrong, effective loyalty, what is that? This is something which you call as risk, that it is mitigated. Okay, so such risk is mitigated, right? And if, let's suppose, this identification is already completed, see, the things have already been looked at. Now, who has done this exercise? Now, this entire exercise, as we talked about, who has done this? Who has looked into this? It's the entity. Yes or no? It's the management who has looked into this. So that's why It's important for now the auditor to do the risk assessment basis this. Yeah. So now comes a point. What will be a risk? What does it comprise of? And how do you really go and mitigate that? Yes or no? So now, let me just take you to a document now. Let's try to understand that. Okay. Yeah, so there you go. Now, what is the risk? I think over here, you will get a clarity. Okay, so that's the risk. Now, a question may arise, how do you mitigate that? Maybe in the first instance, by not using the mobile. In the second instance, by tying the seam belt. Correct? So you can say risk is nothing but something that can go wrong. What can go wrong? So when an auditor is required to look into it, so what will the auditor do? Auditor will check what can go wrong. Correct? Now, this possibility of occurrence of any undesirable events or circumstances which may arise. So now comes the question that who will be bothered about it? Means what's the concern? Is it you? Is it your firm? Or is it the client and others? So that's the thing we need to look into. Correct? Now, when you talk about this risk, there again we have this segregation of the risk. Okay, now how do you really segregate the risk? So now, because the risk is being discussed is in the context of audit. Okay. So now, in relation to the audit of the financial statement, now how do you really define the risk? Now, what do you mean by this risk in relation to audit, or something that you call as audit risk? Yeah, so let's look at this definition. It's a risk that auditor expresses an inappropriate opinion. Correct? Yeah. And exactly this could be the risk. Why? Because as an auditor, what is required to be done? Expressing an opinion. Yeah, that's what is required to be done. Now, in this context, something which is required to be done may not be done in an appropriate manner. Yeah. So now what could be the examples for that? So let's look at it. Maybe the auditor is issuing an unqualified report where a qualification is required. Okay. Or maybe auditor is issuing a qualified report where qualification is not required. So there's also a particular section in the auditor code. I think this is something we are going to cover later on. But because you already know about it, it's more of a revision we are doing. So there's also a section which could be there in the report in relation to emphasis of it. Correct. Now, what if the auditor fails to bring in the EUM? Now, in that case, what do you say? Where do you part of the audit report? You can say should have been the part of the audit report, but actually it's not included. So that is again a risk. That is again a concern. Yes or no? Next, providing an opinion on the financial statements where no such opinion may be reasonably given. Okay, where no such opinion may be reasonably given due to significant limitation of scope, the performance of work. Now let's suppose you are not getting the information. So how do you complete the audit? Isn't it? If the information is sufficient and meeting the criteria, what is the criteria? Sufficient and appropriate audit evidence. Once you have that, yes or no? Once you have that, only then you will say that the audit report is being issued by following all the required professional standards or maybe the regulatory norms. Correct? Now, for the purposes of our discussion, I think you would have also looked at it. Audit risk may be considered as product of various risks. See, actually, when you go audit, and if you are looking at any risk of material misstatement, okay, now in that case, what will happen? You're through, correct? Because as such, in the business, nothing remains, which is then required to be looked at. Yeah, everything is there already. You need to just use that and move further on the basis of that information which is available. Right? Now, when you talk about this audit risk, this can also be understood by getting onto each of these terms one by one. So basically, we can say audit risk is what? Inherent risk, control risk, and detection risk. Okay. Now, how does they impact? That's what we need to now find out. Correct. Now, let's talk about this first category, inherent risk. The inherent is something we just talked about, but let's look at the technical literature which we have. So we can say inherent risk is the risk of material misstatement in the financial statements arising due to error or omission. Yeah, so it's quite straightforward. Why? Because when you talk about inherent risk, you are talking about those which are arising due to error or omission, other than the failure of controls. So that part is not covered. Now, wherever you have any estimates involved, okay, so the significant judgments may have to be considered. Right? Now, inherent risk is generally considered to be a higher where a high degree of execution and estimation is involved, or where the transactions of entity are highly complex. Okay. Otherwise, do you really get into such a complex scenario which will be of not much use to you? Answer is no. Correct. Next. So this inherent risk basically. Okay. Now this inherent risk basically is the one that we have in relation to the concerns which might be there. Okay. Now, what is that? How does it impact us? Next, control risk. Now, as the terminology suggests, over here we are definitely talking about what controls? Yes or no? Yeah. So we are talking about controls, undoubtedly. Right? Now, in that case, we can say there is a risk of material misstatement in the financial statements arising due to absence or failure in the operation of the relevant controls of the entity. Correct? And that's where this control environment is focused upon. When you look at the entities, they have adequate internal control systems. Why? Because what is the objective here? It's more of preventive. Correct? Now, when you talk about assessment of control risk, okay, so now in this case, what will happen? Let's suppose it's a small size entity in which segregation of duties is not well defined. And the financial statements are prepared by individuals who do not have the technical knowledge of the accounting and providing. Okay. Now, since then, will it make a difference? Answer is yes. Correct. Next, detection risk. So we talked about inherent risk. We talked about we talked about inherent risk. Then we talked about control risk. Now we will talk about detection risk. So let me just take you to the chart that we looked at. So that's the one you will have for what? For the projects we just discussed, right? And now we are discussing about this third element. So let's look at this. You can say it's a risk that the auditors fail to detect a material mistake. Now over here, a question may arise that what if the auditors fail to detect? Can this not be captured in the physical verification? Can this not be looked at by the management itself and then highlighted? See, when you talk about the management and all of these, they will definitely rise. But what is going to be the time frame? No. Yes or no? And over here, the concern is what? Over here, the concern is about the information which keeps coming. Yeah. So that is another very important aspect one needs to consider. Next, auditor must apply appropriate audit procedures to detect material misstatement in the financial statements, whether due to fraud or error, plus misapplication or commission of critical information. Yeah. Next, continuing on this detection risk, sometimes what may happen is some you can say projects or some tasks rather, they are highly dense. Correct. So that's why one must understand the fact that the way the verification is required to be done, the way the information is required to be processed. So what will happen? So the firms, I'm talking about the firms right now. So the firms which are not technically enabled, in fact financially also, so you don't know about its fate as to what's going to happen. Yes or no? So that's where it becomes all the more important. Right? Now, before we move further, any questions, any doubts that you may have? I can see Manish is there. Huh? Yeah, Manish. Any questions, any doubts if you have? Okay. Yeah. So now let's move further. Okay. So Manish is clear on this. Very good. Now, see, we were discussing risk assessment and we slightly digressed. Yeah. No. Coming back to the same aspect. When you talk about risk assessment, I think we have had some discussions. Now, this risk assessment process actually involves what? Involves a lot of other activities as well. Right? And that's why is evaluation is required. A thorough evaluation is required. Yeah. So now, for the risk assessment to be done, what do you do? How do you really go about it? Correct. First of all, and the most important of the all is what? Obtaining an understanding of the entity and its environment. In the meantime, I think, Manish, because you have around, if you have any thought process around it. In the previous sessions, we have talked about understanding of the entity in terms of its importance. Let's once again talk about it. Now, what is really this understanding of the entity implying? What is it that you consider? Correct? Yeah. So both the factors are required to be considered. Now let's assume that's done. Okay, let's suppose you have understood the entity. You means your engagement team members, they will go there collectively. Okay, they will try to get into the information which might be there. Okay, and which is really required to be processed. Yeah. So in such a case, what do? and how does it help? Now let's try to think about it. In an audit, in a very simple terms, we are discussing what will happen. Say it's the auditor, and this is the company. It's the company, right? Now, in this case, say the auditor doesn't have much of the understanding of the business, right? He has not actually got into the details of the understanding of the processes as well. That's not been done, right? Something that you talk about understanding is briefly covered, not really got onto the details. Of course, like Manish mentioned, which industry is that, what type of structuring is that, what type of finances the entity is having, in terms of the management, the organizational structure, the governance mechanism. Okay? Most of these parts have not been understood. So auditor comes, take the trial balance, scrutinizes the trial balance, asking for the ledger, correct? Now, all of these are what? All of these are application of the planning. Why? Because these are the audit procedures the auditor will perform. Yes or no? So therefore, in this case, what is important? It is important to not only obtain the understanding, but also to obtain a thorough understanding. Why? Because tomorrow when the auditor will go and ask the questions, so for those questions to be understood as to what do they require, what do they include, how do you really go about it? That's where you'll need this understanding. Correct? Now, based on the understanding which is there, what will happen? Risk identification will be done. Which will require all sort of activities as far as the risk assessment is concerned. Yes or no? Now, once you do that, once you get on to the identification of the risk, what do? You will check whether this risk, okay, is significant or not. Okay, something that we just discussed, talked about, right? Now, in this case, when you talk about understanding of the risk, understanding of the aspects related to that, now where do you need that? What is really required to be done? You need to get on to the focus areas for them. And this direction is provided to you once you have this assessment completed. So just understand that if this assessment is not completed, will you really be get down to this level? Answer is no. Answer is no. Okay. So that's where this is important. That's where it is really required to be done. Okay. Yeah. So now moving further. Further. So I'll just go back to the document. Just give me a minute. Let me just share this with you. Okay, so there we go. So this is about the risks we just talked about. As to how do they really connect with each other, and what are the objectives you are basically trying to fulfill by getting into this part. And all the procedures that you plan should be impacted by whom. You can say should have some sort of consideration around whom, around this part as well, right? Now, some of these aspects we have discussed, so I'll just skip this part. Once you have this risk identification, that's where you get on to the control system. And now comes another important part, internal control system. In a very simple terms, we can say it's a system of internal control. Basically, the way the organization will be mitigating. Okay, the way the organization will be mitigating some of its things which are in place as far as the risks are concerned. So that's how they will want to go about it. Right? And to put it in a very simple manner, you can say against each activity, what will happen? Entity will plot down a control. Or you can say a mechanism through which such risk is taken care of. Such risk is addressed. So that's what the entity will try to achieve. Yeah. Now, this system of internal control is extremely important. Why? Because if, let's suppose, the risks are identified, as a next step, what will the management do? As a next step, management will then identify the controls. Okay. They will design such controls. And once the controls are designed, once the controls are put in place, what will happen? That's when the entity will also ensure, or you can say there has to be a mechanism on the part of the entity around what? Around the aspect related to whether those controls are operating in an effective manner. Yeah. Okay, so that's why when it comes to the control system, so we can say there are two parts to it. What is the first one? Design. So is the design essential? Yes. Why? Because that's the first thing you'll start with. Right? That's the first thing you'll start with. And if let's suppose you have the design as a company, let's suppose design is in place. So the company has documented that these are the controls. Okay. But those controls are not working. Those are not operating. So what is the use of that design? Will that design be of any use? The answer is no. It's useless. Yeah. So the end goal is what? End goal is to reach a stage wherein the controls are operating in an effective manner or not. Because once you have that, once you reach that stage, only then you get the comfort around as to whether the, you can say, risk management system is functioning the way it's required. And that's how you reach a stage wherein as an organization, the governance mechanism that you want to establish. Okay. So all of those things you will then be able to do. Yeah. Not otherwise. Which becomes challenging then. So now, just to look at the definition of this internal control system. So what is that? It's all about the policies and procedures. So if you look at it, it's all about the policies and procedures adopted by the management of an entity to assist in achieving the objectives in relation to the conduct of business, adherence to policies, safeguarding of assets, prevention, detection of fraud and error, accuracy, completeness of accounting records, timely preparation of reliable financial information. Right? Now, so this is about the system of internal control. And we have also understood as to, why this is really required. How does it really help the organization? Now, if let's suppose we have this system, why is this required? It helps. So what will be the structure of this internal control? Let's think about it. What's the structure of this internal control? So in order to achieve the objectives of internal control, all of these policies, procedures, which you put down in the form of that system, they should cover first segregation duties. Very, very important. Why? Because if the segregation of duties, if this mechanism is not set, what will happen? That's where the accountability also becomes very difficult. So how do you fix the responsibility? Yes or no? Yeah. So that's where this is an important element to be considered. Authorization of transactions in relation to that. Adequacy of records and the documents. Accountability and safeguarding of assets. All of these are what? They are nothing but forming part of this. Now broadly, if let's suppose we were to look at the internal control system, you can say it has got some components. So the way it is structured. Okay, so this has 5 components considered to be the essential components, and that's the crux basically as around the mechanism to be looked at. First, it talks about the control environment, which is all about communication and enforcement of integrity and ethical values. commitment to competence, participation by TCWG, management philosophy and operating style, organizational structure, assignment of authority and responsibility, human resource policies and practices. Right? So this is all what? This is all a part of the system, of the control environment to begin with, because it's not only about performing the procedures, it's also about obtaining an understanding of the same. Yeah. Because once you have that, only then you will be able to go audit that. Only then actually you will be able to audit that in an effective manner. Otherwise, you may not be getting the right thing. Next, entities risk assessment. This is something that we have been talking. Control activities. Whether you talk about control activities in the form of performance reviews, information processing, physical controls could be there. Say physical security of assets, authorization for access to computer programs and data files, right? Segregation of duties, again, very important. Next, information system including the related business processes relevant to financial reporting and communication. Okay. Monitoring of controls. All of these are what? All of these are nothing but the components of that control system. Yeah. So you can just understand that without this control system, do you really achieve the objectives? Answer is no. Answer is no. So that's why it's considered to be a very, very important ingredient. Correct? Now, as we discussed, first of all, control environment, this control system having various components like control environment, etc. As an auditor, you go understand that, right? And once you understand that, that is where you will get into the review. Why? Because that's when you will be able to design the audit procedures. So basically, it's all about responding to the risks which might be there. Okay. Now, for the auditor, when you talk about the quality and effectiveness of internal controls, it's basically directly dependent on the organizational environment. Something which is very commonly referred to as tone at the top. Yes or no? Means the way the top management is looking at the things. What is their perspective? What actually they want to achieve? All of these things become very important. Now, some of the key components, let's suppose if you were to assess and evaluate the control environment. Now, what would that be? SOPs, ERM, of course, segregation of job responsibilities, yeah, job rotation in sensitive areas, IT-based controls. All of these are what? All of these are essential elements to be considered. Now comes the point that if let's suppose you were to evaluate. So how do you evaluate? Yes or no? So how do you really go about it? How do you actually evaluate that? Correct. Yeah. So now let's try to understand the techniques which are there. Questionnaire. Okay, the first one. And I'm sure some of you might be familiar with this because it's not only about audit. Even at other places you see this. Now what is a questionnaire? As the terminology suggests, it's a document comprising of various questions. Of course, around the subject matter. Okay, but it's a set of questions. So you can say in the context of a financial statement, what will happen? Say you have different captions and various assertions which are mapped to say each caption, and risk control has been identified, that's also been mapped. That's when you will get onto the audit procedure. So no. Now for you to get onto that audit procedure, what do? You will have some standard set of questions. Okay. But if we apply a standard set of questions to an entity, so there is no, not really. That's not an appropriate mechanism to go. So therefore, what should you do? How do you really go about it? So the question should be specific to the entity which is under audit. Okay. Yeah. Let me just try to say on to this next aspect. Checklist. See, a checklist is what? Again, it's a document having questions. But unlike questionnaire, this document is all about checking in a very brief manner as to whether there is an assent to this or dissent to this. Yes or no kind of mechanism is there. And of course, sometimes you may have this not applicable as well. And so that's the way you will want to consider this. Right? Now, when you talk about a checklist, so you can say it's basically a mechanism through which you try to ensure that nothing gets missed out in a way. Yeah. So basically, it's more of in the nature of a reminder to the auditor about the matters to be checked for testing the internal control system. Yeah. So I can see this query here. So of course, questions are something we are going to eventually move on to questions on. Yeah. Yes, so a lot of questions we are planning to cover, don't worry. And then that's something we have been focusing upon quite a lot. So the same thing you'll see over here as well, right? Now, when you talk about a questionnaire, it's basically a set of questions that you'll put to the client. Okay, a checklist which may be in the form of instructions, questions, or just point to which. Yeah. Now, what are the differences if, let's suppose, you were to compare? So the questionnaire incorporates large number of questions and which could be detailed as well. But checklist is more of course, questions. Large number of questions could be there. It's not only, it's not about detailed one. It's more about, you can say, a sort of check whether it's there or not in the form of yes or no. Generally. Okay. When you talk about a questionnaire, questions are usually answered by company executives. When it comes to a checklist, do you find these are required to be answered by the auditor or the staff of the. Yeah. Similarly, there is also a mechanism called as flowchart. Now, flowchart is something with which you are already familiar. Okay, so something like this, you can say, are the symbols you get to see in case of a flowchart. See, the objective of flowchart, first of all, is largely around the documentation of the understanding of the process. See, there are two ways you can go about understanding. When you go understand the process, you put down each and everything step by step in detailed manner. Or otherwise, you can give it a shape of flowchart. So if you do that, if you give it the color of a flowchart, so what will happen? The clarity increases. Okay, so it is something which is providing an ease of reference. You don't have to get into the details to understand each and every step. So you can say that's a benefit. On the top of it, if you want a descriptive thing, you can always put it down. Yes or no? So that's how flowcharts also help the organization. So something which you can see on the screen right now. So there's nothing but a flowchart. So similarly, for different set of processes, you will see such flowcharts. Right. So again, you have this flowchart. Again, this is nothing but a flowchart. Correct. Next. Now, when it comes to the reporting, of course, basis the conclusion we draw, again, we'll have to reevaluate as to, how do you really go about reporting some of these aspects. Correct. Now, moving further, now, before I really get on to the questions, so I'll just quickly touch upon this concept of materiality. Okay, now let me just open this document up. Now, materiality is something with which you are familiar with already. And needless to stray, it's extremely important. And it's judgmental. Now, why is this required? Because the entire audit we do is basically for what? Basically, the entire audit we do is for the purpose of giving a true and fair view. Correct? Yeah. Which will require ensuring financial statements are free from material misstatements. Yeah, they are free from material misstatements. So that's why you can say that when it comes to the audit, the objective of audit is what? Objective of audit is to look at this, you can say sort of level. Yeah, because basis this your entire audit will move. Correct. Yeah. So that's why materiality is considered to be extremely. Now comes the point that what do you mean by materiality? Yes or no? And how do you really get into its assessment? So when you say materiality, so what are the considerations you'll have for the materiality, right? So let's look at this document and let's try to understand about materiality, because materiality is not only theoretically important but practically also it is an extremely important area, and one area wherein a lot of improvement is required. So there's a scope of improvement quite significant. Why? Because the application of this concept is still a big problem. So we are not saying that it's too difficult to apply. No. But the way the auditors are doing this, either there's a lack of understanding or maybe to a certain extent it's not being applied the way it's required to be done. Yeah, so you can say, so there's a gap, there's a big gap which needs to be fixed, which needs to be sort of sorted out, right? Now, what is materiality? As we just discussed, that misstatements, omissions considered to be material if they individually in aggregate expected to influence economic decisions of the users of financial statements. Correct. So that is materiality to begin with. Why we need materiality? One, misstatements exceeding the materiality could influence the economic decisions of the users of financial statements. Two, planning stage you need materiality. Why? Because you perform the audit basis that. For conclusions you'll need materiality. Why? Because your outcome, your errors, whether those are material or not. So till the time you don't have the threshold, you are not determined. How do you reach the conclusion? Okay. And the most important aspect happens to be the determination of this, which is judgmental, which is quite subjective. Thought process is required as around this. Okay. So now, when to use, I think we have talked about this quite a lot. Now, why is this important? We have discussed this. Now comes the point, how do you determine that? And this is something which is, you can say, one area wherein we find a lot of problems. First of all, there will always be a benchmark. Say PBT, revenue. Now this is what? This is nothing but a benchmark. Correct. That's how you will begin. That's how you will begin. Now, how do you select the benchmark is important. There are again certain parameters which you need to consider, but at the end, it all comes down to the judgment of them. Of course, the judgment has to be logical, backed by the guidances which are in place. But there's no clear-cut laid out rules you follow. Yes or no? So that's where we are saying the professional judgment is something which is required, which will help you determine the materiality. Basis what? Basis these factors. So these factors will help you reach the conclusion. Correct? And once you have the benchmark, you will also be then selecting the range. So there are range, you can say, to reach the quantitative threshold. Okay. Now, let's try to look at some benchmarks. This could be quite helpful. Why? Because at times, what do? You don't really get onto the benchmark right. Why? Because if let's suppose your basis is not correct, so what may happen? Materiality may not come out to be the one that you are really looking at. Okay. So the first one, talking about the industry, say it's commercial for profit entities. What is the benchmark? You'll always want to have PBT. Say it's a public entity or a listed entity, again PBT. But if let's suppose the profits are volatile, last year profit was 80, now it's 110, next year it's say 95. Now in such a case, if you take the benchmark of the profits, will that be an appropriate thing? Answer is no. Yeah, so that's why what do? You now shift from profits to revenue, or you normalize them. Let's suppose entities are at break-even levels. So there again, you move to revenue, means the other benchmark will be total assets. If let's suppose they are into losses, again revenue, total assets. These are very important now, because if you don't apply that, you can understand your materiality may differ significantly. If let's suppose entities are very small, closely held, total assets, those are not for profit, again revenue, assets. Financial institutions, NBFCs, so they're in the total advances becoming. So that's one of the things you want to consider. Now for the benchmarks which are there, again what will happen? There will be a range within which you move, right? Now for these ranges, what will happen? You have this lower range. You can say that it's a point on the lower side, it's a point on the higher side. Now, how do you get into that assessment as to which amongst this range, what percentage you select? So that could also be a question, that could also be a thought process. So how do you really go about it? Okay. So now in that case, what do you do? That case, you will look at the history. Okay. Now in that case, you'll have to get into the selection of that. I think we can look at this question also to discuss this further. Say an entity in the past years, what do you find? Control systems are weak. There are a lot of errors during the course of audit that you come across. So what will happen here? Your confidence, the comfort level as an auditor is lower. Correct? Yeah, why? Because you don't know about the errors. So that's why if you select a higher threshold for the materiality, you will end up ignoring those errors, which is not appropriate. So that's why what you do will cut down on the materiality. So that's where what will be on the lower end of the range. But if let's suppose entity has strong systems, as an auditor, you generally don't come across issues related to, say, errors. Financial reporting has been strong. Okay. As among the management side, as among the KMP side, you don't see concerns. So that is where what will happen? That is where you'll want to have more comfort. And that is where you may want to cut down on some of the procedures, extent of testing. Why? Because your comfort level is higher as compared to the first situation that we talked about. So that's where what do you do? So that's where you will get into the higher range of that range, or you can say the higher levels of the range. Correct? So let's look at this example. ABC is a company providing IT services across different sectors. ABC is specialized in providing solutions through AI. Okay. Major clients of the company, they are from banking and financial institution sector. Companies listed on BSC and C. Okay. So you can see the profits are 500 million. Revenue is also given total as well. So information is given about the company. Year-on-year profits of the company are growing at an average rate of 8 to 10%. But in the current year, an impairment loss is recorded amounting to INR 2 billion, which is adjusted in the above profits. Okay, so during the year, you see this one-off kind of adjustment, which has cut down the profit. Company over the past years has maintained good dividend payout ratio, and the investors drive their return on investment from this. Okay. Now, what is the most appropriate benchmark given the situation here? So, profits, or you can say adjusted profits after eliminating that impact of adjustment, revenue, or you can say total assets. Yeah. So now in this case, what should you do? Because you are looking at the profits year on year, don't find volatility. Okay, so margins are quite set basis the business model. This one-off adjustment which is impacting the P&L, how can you normalize that? By just taking out this impact of the impairments. Yeah. Okay. then I think materiality. Would your materiality change if a company is a closely held private company? Answer is yes, of course. Performance materiality. See, once you have the materiality, now that is where you see this another term. Now, why is this relevant? This is relevant because of the fact that there are some inherent limitations of the audit process. Say this is the population. You have audited this part. Why? Because this was forming part of your sample. Yeah. So this part you didn't audit. Because we are not doing 100% checking. Correct? You are not doing 100% checking. That's why you didn't audit this part. Okay. Now, for the samples which are not selected, how do we say that those samples are going to be error free? What if they have the error? Are we really checking that? Are we really required to check that? Can we do something about it? No, that's basically the approach with which the audit is performed. Yes or no? Yeah. So do you really go about it? No, you don't do that. Yeah, so there are chances that in respect of those samples for which the testing is not done, why? Because they're not forming part of the testing, which have not been selected. Errors may remain. Now, what do you do about that? How do you manage that? You manage that by reducing the materiality level, by giving yourself a cushion. So let's suppose your materiality is 100. So now instead of keeping it 100, now you are bringing it down to 70. Why? Because this cushion of 30 you want to give to this portion, which may also have some errors. Okay. Now this 70 is what you call as performance materiality. And this 100 is what you call as materiality. Now, what is trivial? So there's also a third term which is used in the context of materiality. Clearly trivial threshold, CTT, or at times this is also called as de minimis. Right? It's one and the same thing. But over there, we are looking at the threshold, which is too low. Okay? Below which, if you have something, and even if that gets left, that doesn't impact. Okay? That's what you call as clearly trivial threshold. So that's where you see these three terms in respect of the materiality. Right? Now, if let's suppose when you assess the materiality, when you are determining the materiality, when do you do that? At the planning stage? Yes or no? At the planning stage, you will do this exercise. Why? Because that's when you are planning to perform all the procedures. Now say at the planning stage, you have determined the materiality, it was 100. At the planning stage, do you have the final numbers? So you received a draft trial balance, basis which you considered 100. Now you've started the audit. Now during the course of audit, a lot of adjustments have come. So there were a lot of mistakes. Client is passing the adjustment entry post audit. So these are also called as audit adjustment entries. Now what will happen? Now it may happen that basis significant adjustments, this profit may go down to 80, right? So earlier the profit, or so let me just put it as profit instead of materiality. Earlier, let's suppose the profit was 100. Okay. And we considered a materiality as 4% of the profit. Now the number has changed. Okay, so if you take 4%, will the materiality change? Answer is yes. So the question arises that the materiality that we determine is not really fixed. See, the answer goes back to the discussion we had around the planning. And what is that? That anything in respect of the planning we do, we need to be flexible on that. Okay. Because when it comes down to the planning is not something we do and just close it over there. Yeah, so it's a continuous process. You need to stay dynamic and you need to be flexible in terms of the planning. So any changes you require, you need to do that. Okay. Yeah. The same goes with materiality as well, because this is nothing but a part of planning. So that's why any changes you require, will you be making those changes? Answer is yes. Because if let's suppose your materiality is too low, what will happen? Your extent of testing goes up. So you are reaching a stage of over audit. If it's too high, you are doing under audit, and both of them are not appropriate. See, under audit means there's a risk in terms of the audit not being done. Over audit means today when you pick up any project, so there's a cost associated to that. There are timelines around it. Yes or no? So these situations, both of them are not efficient. Yeah, so you need to reach a stage which is sort of efficient, wherein you are at the right level. Okay. Now, documentation, of course, as we discussed, again a very very important element as far as the planning part is concerned, or even if you look at any of the aspects related to the organization, all of these things will play an important role. Okay, so now what we can do is we can take a break, and after the break we'll move on to the questions. So now we'll discuss the questions, some of them from the RTP previous one. Yeah, so all of those questions we are going to pick up as on the topics we discussed. Okay, so now we can take a break and let's meet after the break. we can continue. All right. So now, yes, so what I'll do is I'll just move on to some questions now. So just give me a minute. Okay, so I'm picking up this RTP first. Yeah, so let's look at this. CA Kavya has been appointed as the statutory auditor, okay, of XYR Infratech Limited, and we are given this financial year, and some of this information is available about the company, okay, in terms of the business segment. So there are two business segments the company is operating in. Then, now these two business segments happen to be the consumer electronics division, which manufactures the smart televisions, and in terms of the profitability, so you find that the profits are stable over there. Okay. Then the other division is about the infrastructure development. So this is engaged basically into the metro rail projects under the government contracts. Now this division has been reporting operating losses. So that's what you see in the past 2 years due to delays and the cost overruns. Okay. Now, while planning the audit, CA Kavya needs to determine materiality for the financial statements as a whole. So it's all about determination of the materiality. She seeks guidance on the factors, first of all, in relation to what? The benchmark that needs to be selected. I mean, what should be the appropriate benchmark? Okay. And of course, because there are two business segments. Okay. So now, which benchmark you'll apply to each division, right? Now, let's look at this one. So how do you really get on to the assessment? Now this SA 320 talks about determination of materiality. So which is of course a professional judgment. Professional judgment basis the guidance, basis the factors. Okay. A percentage is often applied to a chosen benchmark as a starting point for determination of materiality. Now, what are the factors one may consider? What are the elements of the financial statements? Assets, liabilities, means in terms of the numbers, that's how you will analyze. Because when you talk about the financial statements, of course, it will be quite standard, but again, they may vary from industry to industry. Yeah? Whether there are items on which attention of the users of the particular entity's financial statements tend to be focused. So for example, for the purpose of evaluating financial performance, users may tend to focus on profit. revenue, net assets, right? Nature of the entity, where the entity is at in its life cycle, and the industry and the economic environment in which the entity operates. What is the ownership structure and the basis of financing? Means, is it purely the debt rather than the equity? So the users may put more emphasis on assets and claims on them than on the entity's earnings. And the relative volatility of the benchmark, means how volatile is that. Okay, now determination of materiality is about what? Basically, now you will select a percentage. Once you select a benchmark, what is the next step? Now you'll have to select a percentage. Okay, so X percentage of that amount you will consider. That's how you will determine, correct? When you talk about the quantitative threshold. Now, determining a percentage to be applied to a chosen benchmark involves exercise of professional judgment. There's a relationship between the percentage and the chosen benchmark, such that a percentage applied to PBT from continuing operations will normally be higher than a percentage applied to total revenue. Okay. Yeah. Now, coming back to the entity that we have. Okay, so the specific case scenario. This is more about the guidance. So that's how you'll always start. Okay, because you'll want to discuss the guidance. Of course, when you're talking about the guidance, you should not be loading the solution with too much guidance. Try to be down the relevant guidance. Relevant means relevant in the context of the solution you are going to provide, specific to the situation that we have. Okay, now in the given case for this company XYR Infratech Limited, there are two divisions: consumer electronic and infrastructure development. When you talk about consumer electronic, so it's a profit making. Year on year, you find profits. Those are stables. Sorry, those are stable profits. So that's where the preferred benchmark, of course, PBT is something you will want to pick up. Yeah. So therein the benchmark is going to be what? PBT. Okay. Next, infrastructure development division. Now it's a loss making. So therein, do you apply the PBT? Answer is no. So in this case, revenue or the gross profit may be used as benchmarks. Alternatively, consider its public utility nature. Okay, basis that you may also consider total cost or net cost. Yeah, but again, this will have to be evaluated considering the numbers which are also involved. Where significant assets are involved, therein you may also go with total assets, right? Because now once you are not looking at the PBT, of course, now the other one you need to consider some of those which are going to be the relevant one in this case. And once you have that, the next step will be to consider the percentage that you apply. You have the range available, so you need to move within that range. So you, of course, cannot break the range which is available, but any percentage that you consider within the range, that again needs to be justified. Correct? Okay. Yeah. Now moving further. So we'll pick up some more questions now. So just give me a minute. So there you go. So let's look at this one. Okay. B was appointed as auditor of ABC Limited for the financial year 25-26. So the company is ABC. B has been appointed as the auditor. During the course of planning for the audit, B intends to apply the concept of materiality, which is an important step, correct? Please guide him with respect to the factors that may affect the identification of an appropriate benchmark for this purpose. Number one, what benchmark should be adopted by B? Okay, so now you can say this is your kind of part A to this question. Now, what benchmark should be adopted by B if ABC Limited is engaged in manufacturing and sale of air conditioners and having regular profits, construction of large infrastructure projects, incurred losses in the previous 2 financial years due to pandemic. So this is not something which is normal, it's abnormal, correct? So that's one of the factors you need to mindful of, right? So now let's look at this. Okay, so now use of the benchmarks in determining the materiality for the financial statements as a whole. Now, what are the benchmarks you will consider? Now, as per SA 320, determining the materiality involves exercise of professional judgment. This is an important ingredient here. Okay. A percentage is often applied to the chosen benchmark. So first step is what? Choose the benchmark. Once you choose that, you will have this percentage that you apply on that. Okay. Now, what are the factors you may consider for the same? I think these are some of the factors we just talked about. Elements of the financial statements to begin with. Whether there are items on which attention of users of particular entities' financial statements tend to be focused. Say, if let's suppose one wants to evaluate the financial performance, what do? Focus on profit, focus on revenue, right? nature of the entity, where the entity is at its, in terms of its life cycle. So where is that? Industry and the economic environment in which the entity operates. Again, an important consideration. Yeah. To look at the ownership structure. Now this will also be required. Yeah. So ownership structure, how the entity is financed. Yeah. Now, of course, it's a matter of judgment, and of course, once you have the benchmark, you also get onto the percentage. Now, in the given case, I think we have a similar sort of situation. What is that? When you talk about the division in terms of manufacturing, sale of air conditioner, it is having regular profits. Now, that's the key. So, therefore, what do you do? Therefore, as an auditor, you may consider PBT. So, that will always be the preferred one for you. For the other one, let's suppose if you talk about the situation where the entity is engaged in construction of large infrastructure projects, and most importantly, incurring losses which are abnormal. But it's been 2 years. Okay. Because you do not have the profits, because maybe prior to 2 years you had profits, now you are having losses. So volatility is definitely there. Now, in such a case, what do you do? Look at the other benchmark, say revenue, if at all there is gross profit. Okay. Alternatively, other benchmarks like total cost, net cost, and again this one, assets, would also be the consideration. Right? Next. What are the components of an internal control framework? I think we just talked about it. It's more of theoretical, so I'll not really want to get into that. Explain briefly the flowchart technique. This is again more of theoretical. We just talked about it. Now, moving on to the next one. So let's look at this one. As an auditor of Z Limited, you would like to limit your examination of account balance tests. Okay, so it appears you want to follow a sort of restricted approach. Okay. Now, in this case, what are the control objectives you would like the accounting control system to achieve? Okay. So in this case, you need to have a discussion around the control objectives. Yeah. So let's look at this. Basic accounting control objectives which are sought to be achieved by the accounting control system. What is that? Whether all the transactions are recorded, whether recorded transactions are real, whether all recorded transactions are properly valued, whether all recorded transactions are, means whether the recording was done in a timely manner, whether those are properly posted, properly classified and disclosed, and are properly summarized. Correct? Yeah. Okay. Now moving further. Let's look at this. Now you are required to compute overall audit risk. Remember risk, audit risk. So there were three, you can say, kind of components to this: inherent risk, control risk, detection risk. So that's what you talk about when you're considering the overall audit risk. Correct? Compute the overall audit risk if, looking to the nature of business, there are chances that 40% bills of services provided would be defalcated. Inquiring on the same matter, management has assured that internal control can prevent such defalcation to 75%. At his part, okay, now when it comes down to the auditor, at his part, the auditor assesses that the procedure he could apply in the remaining time to complete the audit gives him satisfaction level of detection of frauds as well as the errors. Okay. Fraud means, so how do you differentiate? So this is in relation to something which is intentional. Over here we are talking about something which is unintentional. Correct? Analyze the risk of material misstatement and find out the overall audit risk. Right? Yeah. So let's look at this. When you talk about SA 200 in relation to the overall objectives of the independent auditor, conduct of audit in accordance with auditing standards. So we can say audit risk is a risk that auditor will issue an inappropriate opinion while financial statements are materially misstated. Okay, so that's a risk. Correct. Means to say the financial statements are not materially misstated, even if they are. Because that's the risk. Or to say financial statements are materially misstated when they are not. So it can be either of these situations. But of course, there are a lot of other ways the opinion can be given, but any sort of mistake that may be made, that's what the audit risk is all about. So you can say it has got two components. One, what's the first one? Risk of material misstatement and detection risk. Yeah. Now, what do you mean by risk of material mistake? So you can say Basically, risk of material misstatement is anticipated risk, that a material misstatement may exist in the financial statements before the start of the audit. Yes or no? It has two components: inherent risk and control risk. Yeah. So basically, this is about two things: inherent risk and control risk. Yeah. Now, what is inherent risk? What is control risk? We discussed, but let's look at this again. So when you talk about inherent risk, basically it's the susceptibility of an assertion about account balance, class of transaction, disclosure towards misstatements, which may be either individually or collectively with other misstatement, becomes material before considering any related internal control, which is 40% in the given case. Okay. Now, how do you get 40%? So that's something which is given to you. That's the information provided in the question. What is control risk? So basically, it's about the controls. Okay. So over here, we are talking about a risk that there may be chances of material misstatement. Even if there is a control applied by the management, it has prevented the defalcation to 75%. Okay. So that means, what is the control risk? 100 less 75. So it is 25%. Correct? So now, risk of material misstatement, first of all, if you were to get to this risk of material misstatement, inherent risk, control risk, 40%, 25%, which is 10%. Yeah. So chances of material misstatement are reduced to 10% by the internal control applied by the management. Yeah, basis the analysis. Now, when you talk about detection risk, now it's a risk that material misstatement remain undetected, even if all the audit procedures are applied. So we are not saying 100% testing. We're saying all the required audit procedures are applied the way it's required to be applied. So despite that, what will happen? Say there are material misstatements. So what is the detection risk? 100 minus 60. That is 40%. So in the given case, we say overall audit risk can be reduced up to 4%. Why? Because 10 is the risk of material misstatement. 40% is the detection risk. So where do you reach? 4%. Yeah. Clear on this? Okay. So now, moving further. Let's look at the next one. Y Company Limited has 5 entertainment centers. Basically for what? To provide recreational facilities for public, especially for children and youngsters, at 5 different locations in the peripheral of 200 kilometers. Okay. Collections are made in cash. Specify the adequate system towards collection of money. Right? So let's look at this. Now, talking about the control system first of all, over selling and collection of tickets. Yes or no? Now, in order to achieve proper internal control over the sale of tickets and its collection by the Y Company Limited, following system needs to be applied. One, printing of tickets. So a proper system in respect of the printing of tickets needs to be set up. What is that? You can have serially numbered pre-printed tickets which you use. Okay. Now, how does it help? Let's understand that. So when you use serially numbered pre-printed tickets that are designed in such a way that any type of ticket used cannot be duplicated by others. Okay, in order to avoid forgery. Serial number should not be repeated during a reasonable period, say a month or year depending on the turnover. Separate series of the serial should be used for such denomination. Yeah. So that's first part, which is basically in relation to the printing of tickets. Ticket sales. Sale of tickets should take place from the central ticket office at each of the 5 centers, preferably through machines. So there should be proper control over the keys of the machines. Correct? I'm talking about the daily cash reconciliation. Now this is again an important, let's say, a system and very commonly followed across the organizations. Cash collection at each office and the machine should be reconciled with the number of tickets sold. Okay. Serial number of tickets for each entertainment activity or denomination will facilitate the reconciliation. So that will become the basis. So how do you reconcile? That's how you reconcile. Okay. Daily banking. Each day's collection should be deposited in the bank on the next working day of the bank. Till that time, cash should be in the custody of properly authorized person, preferably in joint custody, for which daily cash in hand report should be signed by the authorized persons. Yeah. Entrance ticket. Entrance ticket should be cancelled at the entrance gate when the public enters the center. Advance booking. As regards the advance booking facility, what do? System should ensure all the advance book tickets are paid for. Now, in relation to discounts, free passes, so basically it's the policy of the company, okay, which should be such that the concessional rates, say for group booking, should be properly authorized. signed forms for such authorization should be preserved. Yes or no? Yeah. All right. Surprise checks. Yeah. Internal audit system should carry out periodic surprise checks, say for cash counts, daily banking, reconciliation, and stock of unsold tickets. Okay. Now let's move further. While assessing the impact of uncorrected misstatements in the audit of Mini Builders Private Limited. So uncorrected misstatements means during the course of audit, as an auditor, you come across misstatements. Okay, but what has happened? Client has not passed the rectification entry. So that's why you call them as uncorrected. Okay. Now, during the course of audit of this company, Mini Builders Private Limited, Mr. Gautam encountered a significant issue related to calculation of materiality on revenue. So basically, there is some concern around the materiality calculation. Okay. The initial materiality calculation was based on estimated figures provided by the management, right? Management to estimate full year revenue. Okay. To estimate full year revenue, extrapolated the sales for 11 months to arrive at a figure for 12 months. However, given the nature of Mini Builders as a company in the construction sector, where monthly sales exhibit substantial variations, a unique challenge emerged. Okay. Actual sales for the last month deviated significantly from the estimated sales due to an unexpected slowdown in the project completion. Okay. As a result, last month's actual sales represented only 30% of the estimated sales. Now, Mr. Gautam is confronted with a dilemma regarding the appropriate approach to evaluate uncorrected misstatements using previously calculated materiality. Yeah, so it's all about materiality which is calculated, and you come across some changes as around the situation which is there. So how do you really go about it? Okay, so that's the question. Okay, so that's what you need to now consider as to how do you really go about it. What do you do in such a situation? Okay, now kindly guide Mr. Gautam in the light of the relevant auditing standard. Okay, now let's look at this. Now, if you consider the requirements of SA 450, which talks about evaluation of misstatements identified during the audit, auditor is not only required to determine the materiality. So auditor will determine that at the planning stage, no doubt. But once that is determined, auditor is required to reassess the materiality. Okay. This reassessment is also required. This reassessment is crucial. Why? To confirm ongoing appropriateness of materiality in the light of entities' actual financial results. Yeah, so that's why it's very, very important. Determination of materiality under SA 320 often relies on estimates of the entity's financial results. Given that actual results may not be known during the early stages of the audit. Therefore, before the auditor proceeds to assess the effect of uncorrected misstatements, it becomes necessary to adjust the materiality calculated under SA 320 based on the now available actual financial results. Correct? Now, SA 320 outlines as the audit progresses, materiality may be revised. So this revision is prompted by auditor's awareness of information that would have led to a different initial determination. Typically, significant revisions occur before the evaluation of uncorrected misstatements. However, if the reassessment of materiality under SA 320 results in a lower amount, okay, now that is also a possibility. So it's not necessary that materiality will increase. It may decrease, may go either way, correct? In both the cases, will you be doing the revisions? Answer is yes. So it doesn't matter. So it's not about that you will only increase. Yeah? You need to reassess and accordingly you need to go about it. Now, if the reassessment results in a lower amount, auditor must reconsider performance materiality as well and appropriateness of auditor's procedures, nature, timing, and extent. Why? Because the materiality has gone down, so the extent of testing, the procedures, some of the areas may have to be added. Yeah. So maybe the procedures increase, maybe the samples increase. Okay. So if that is not done, that will be considered to be a situation of under audit now. So that's why it becomes an important consideration. Okay. Now, in the present case, what has happened? It's been identified that the materiality calculated at the beginning of audit, okay, in relation to revenue was based on what? Estimates provided by the management. And management extrapolated the sales for the full year using the actual amount of 11 months. But since the company experiences significant monthly variations, actual sales for the last month were only 30% of the estimated figure. So there's a sharp decline. Okay. Which is possible. Correct. Now in this scenario, Mr. Gautam, who happens to be the auditor, must review and reassess the materiality to ensure its continued validity in the light of actual financial results. So do we review? Do we reassess? Answer is yes. So we review, we reassess. if the reassessed materiality is lower than previously calculated amount. Okay. Mr. Gautam must reconsider performance materiality and appropriateness of nature, timing, extent of further audit procedures. That will also be required. This meticulous approach is essential to gather sufficient and appropriate audit evidence. Yes or no? Otherwise, the evidence you obtain is basis on, you can say, some of the procedures which are limited, which is not appropriate. So that has to be in place. Correct? Now, moving further. Dipti and Company, a firm of chartered accountants, during the audit of Magma Limited, found that certain machinery had been imported for the production of a new product. Okay. Although the auditors have applied the concept of materiality to the financial statements as a whole, they now want to reevaluate the materiality for the said transaction involving foreign exchange. Give your views. Now the question arises, why would the auditor want to get into this? Yeah, so that's something we'll have to look into. Yes or no? So let's look at this. So now move to solution. As per SA 320, when you talk about materiality in planning, when establishing the overall audit strategy, auditor shall determine the material. Obviously, if in the specific circumstances there is one or more particular classes of transactions, account balances, disclosures, for which misstatements of lesser amounts, then the materiality for financial statements as a whole could reasonably be expected to influence the economic decisions of the users. Auditors shall also determine the materiality level to be applied to those particular classes of transactions. Auditors shall revise materiality for the financial statements as a whole. Okay. When do you do that? In the event of becoming aware of information during the audit that would have caused the auditor to have determined a different amount initially. Yeah, so that's when you revise materiality. Correct. If the auditor concludes now if the auditor concludes a lower materiality for the same, therein it's not only about the revision of the materiality, that's already done. This will also require performance materiality to be reassessed, and the underlying procedures, as we just discussed, because maybe those are now required to be looked at a bit more. Correct. Now, if you talk about the given case, Dipti and company as an auditor has applied the concept of materiality, but they want to reevaluate. Okay, so they of course can reevaluate the materiality after considering the necessity of such revision. Given the fact pattern they will have, so that's how they will have to think about it. Correct. Okay, now let's look at the next one. Emro Limited is a manufacturing and trading company of leather goods since the last 10 years. Okay. You are the internal auditor of the company for the financial year 25-26. So when you talk about the financial year 25-26, your situation is that of the internal audit. In order to review internal controls of the company, you visited the departments and noticed head of procurement Mr. Amit has complete control over purchasing, receiving goods, proving payments to suppliers. His actions are not reviewed by any other person in the company. Okay. Company's staff has been working in the same roles for over 5 years without any rotation. Finance manager Mr. Sachin in particular has never had his duties rotated since joining the company. Okay. Store manager Mr. Gupta, who is responsible for maintaining the inventory, also keeps the inventory records. Briefly discuss the general conditions pertaining to internal check system to be ensured by you as an auditor. So that's one. Number two, do you think that the general conditions pertaining to internal check system are violated in the given situation? Okay. So let's look at this. In the given situation, general conditions pertaining to internal check system are violated as follows. I think if you read those situations, they are quite generic and they are quite direct. Okay, so you can just immediately understand some problem is there. First, head of procurement, Mr. Amit, has complete control over the procurement process without oversight. Okay, that's the concern, without oversight. Now, this violates the principle that no single person should control any important aspect of the business operation. Correct? Lack of staff rotation for over 5 years. Now, should this be done? Yes. To prevent any single person from performing the same function for too long. Allowing Mr. Gupta, who is the store manager, to maintain the inventory records while also having the custody of inventory violates the principle that those with physical custody of assets should not have access to the accounting records. Correct? Yeah. Now let's look at the next one. Okay, so let's look at this one. Q is the engagement partner. Okay, it's in respect of statutory audit of LAL Limited. So Q is the engagement partner. While conducting the audit, he has identified some deficiencies in the internal controls. Okay. On further verification of the internal controls of the company, now he came across some deficiencies in the internal controls, and on further verification of the internal controls, he has some indications that significant transactions in which the management is financially interested are not being appropriately scrutinized by TCWG. And also in few cases, he observed susceptibility to loss of an asset. Yeah, so it's a serious concern. He determines on the basis of audit work performed that identified deficiencies constitute significant deficiencies. How and to whom CAQ shall communicate identified significant deficiencies in the internal control? Which all matters shall be included in such a communication? Okay, yeah. So let's look at this. So when we talk about communicating the deficiencies in internal control, so we have this auditing standard 265, which talks about what? Auditor's responsibility to communicate appropriately to TCWG and management deficiencies in internal control that the auditor has identified in an audit of financial statements. Auditor shall communicate significant deficiencies which are identified during the audit to TCWG on a timely basis in writing. Okay. Auditor shall also communicate to the management at an appropriate level of responsibility on a timely basis. Yeah. Okay. Next. You have been appointed as internal auditor of a company manufacturing and trading in chemicals. You have asked your team to review the internal controls and get the first-hand information of each department and their heads and note their respective roles in the company's procurement and inventory processes. Okay. Now, this is something you have done as the internal auditor. Now, your team has observed. So there are some observations we are discussing. First, head of purchase department, who happens to be a relative of promoter, has for several years been in charge of purchasing and sanctioning payments without allowing anybody to question. Okay. There's been no rotation of duties for several years. Most of the employees, in particular, the chief accountant who has a good rapport with majority customers. Storekeeper also has not kept adequate stock records since he joined the company without carrying out physical verification of the assets. Okay. Analyze the specific violations of the principles of an adequate internal check system. Evaluate how these control deficiencies, individually and collectively, increase the inherent and the control risk for the entity. Okay, now let's talk about this. See, basis the observations we have looked at. Following violations of a principle, you can say, in respect of adequate internal check system. So when you talk about internal check system, so it's a system which should be in place. It has got some principles. Yeah. So these observations seem to be violating the principles of the system. So that's how we need to look at it, right? Now, what are those? So when you talk about the procurement department head being the relative of promoter, has been entrusted with both purchasing and sanctioning of payment for several years without allowing anybody to question. This violates fundamental principle that no single person should have complete control over any important aspect of business operations, and that every employee's actions should come under the review of another person. It also breaches the principle relating to distribution of financial and administrative powers and their periodic review. Okay, next. There's been no rotation of duties for several years of most of the employees, in particular chief accountant. Okay. Chief accountant has a good rapport with major customer. This violates the principle that staff duties should be rotated from time to time so that employees do not perform the same function for a considerable length of time. Okay. Next. Storekeeper has failed to maintain proper stock records. No physical verification of assets has been carried out since his appointment. This violates the principle that those with physical custody of assets should not have access to accounting records. It violates the principle that there should exist an accounting control in respect of each class of assets. Okay. There should also be a periodical inspection as to establish their physical condition. Okay. Next, when you talk about impact of control deficiencies on the inherent and control risk, so of course there is increased inherent risk, right? Increased control risk, undoubtedly. So that's going to be there. So the nature of procurement and inventory functions make them inherently susceptible to fraud, such as fictitious purchases, overbilling, theft of stock. Lack of proper controls means these inherent risks are not mitigated. Okay, so that's one. Increased control risk. Non-rotation of accounting staff increases the risk of collusion, which may result in manipulation of receivables. While absence of stock records Physical verification exposes the company to theft, pilferage, incorrect inventory valuation. Identified deficiencies demonstrate that company's internal control system is not operating effectively. This leads to a high control risk in the procurement and inventory cycles. Okay. Next. Rope Limited. It's a manufacturing and trading company of leather goods since the last 12 years, right? Now you are the internal auditor of the company for FY 25-26. Now, in order to review the internal controls of the company, you visited the departments and noticed store manager Mr. Abhishek, who is responsible for maintaining the inventory, also keeps the inventory records. Okay. These are the observations you have. Company staff has been working in the same roles for over 7 years without any rotation. If you look at finance manager, Mr. Krishna in particular has never had his duties rotated since joining the firm, since several years. Head of procurement, Mr. Sumit, has complete control over purchasing, receiving goods, approving payments to suppliers. His actions are not reviewed by any other person in the company. Do you think that the general conditions pertaining to internal check system are violated in the given situation? Okay, so let's look at this. In the given situation, general conditions pertaining to internal check system are violated. Yeah, definitely. First, when you talk about allowing Mr. Abhishek, the store manager, to maintain inventory records while also having the custody of inventory, violates the principle that those with physical custody of assets should not have access to the accounting records. Okay, so this is a violation clearly. Lack of staff rotation for over 7 years violates the principle that staff duties should be rotated periodically to prevent any single person from performing the same function for too long. Head of procurement, Mr. Sumit, having complete control over the procurement process without oversight, violates the principle that no single person should control any important aspect of the business operation. Okay. Next. Ivan and Company, it's a firm of chartered accountants, and it's conducting the audit of a listed company, Pari Limited, for the year ended 31st March 26. They are concerned with the presentation and disclosure of segment information which is included in the annual report of the company. Okay. Audit team wants to ensure methods used by the management for determining segment information have resulted in disclosure in accordance with applicable financial reporting frameworks. Of course, audit team wants to ensure that this anyways you will want to ensure. With reference to the auditing standard, okay, whatever is the relevant auditing standard, Explain the examples. Now you're required to explain the examples of matters that the auditor should consider while obtaining an understanding of the methods used by the management in determining and presenting segment information in the financial statements. Right? Okay. So let's look at this. Auditors Ivan and company wanted to ensure and obtain sufficient appropriate audit evidence. Regarding what? Regarding the presentation and disclosure of segment information in accordance with applicable financial reporting framework. By obtaining an understanding of the methods used by the management in determining the segment information. Okay. SA 501 guides in this regard. Yeah, so what is that? It talks about audit evidence, which is in relation to specific considerations for selected items. Okay. Examples of matters that may be relevant when obtaining an understanding of methods used by the management in determining the segment information. Whether such methods are likely to result in disclosure. Okay. So they include what? First, sales, transfers, charges between segments, elimination of inter-segment amounts, comparisons with budgets, and other expected results. Okay. Say, for example, operating profits as a percentage of sales, allocation of assets and costs of estimates. Similarly, consistency with prior periods and the adequacy of disclosures with respect to inconsistencies. Right? Next. During the audit of Rishabh Limited, so it's a company which is engaged in manufacturing the home appliances. Auditor noted several significant developments in the current financial year. Company implemented a new integrated information system to replace its old accounting software. It also entered into 2 new foreign markets to expand its sales and hired several new employees in the finance and IT departments to manage the increased operations. Further, company introduced innovative smart appliances, incorporating advanced technology, experienced substantial growth in its production and sales volumes. In addition, management changed some of the accounting policies to comply with updated requirements of the financial reporting framework. Okay. While performing the audit, auditor is evaluating whether these developments could affect the reliability of financial reporting. That's one. Right? As an auditor, identify the circumstances in the above situation that may give rise to risks affecting the preparation of financial statements. Briefly discuss how such changes may impact the entity's internal control and financial reporting process. Okay, so let's look at this. In the given case, several departments during the year may give rise to risks affecting the preparation and reliability of the financial statements. the management in such a case will have to identify, evaluate such risks, right? Yeah. So risks can arise or change due to circumstances. Yeah. So something which we already discussed. So let's look at the next one. While conducting the statutory audit of Super Limited for the financial year 25-26, auditor, who's that? C.A. Chintan, identified several weaknesses in the internal control system in respect of the areas such as cash handling, very critical, inventory management, very critical, authorization procedures, again very critical. So these are all what? Very critical. These deficiencies indicated potential risks of errors and fraud. Chintan decided to communicate these weaknesses to the company's management and TCWG through a letter of weaknesses. However, he wants to ensure that the communication reflects the scope, and limitations of the audit properly. You are required to elucidate important points C.A. Chintan should keep in mind while drafting the letter of weaknesses in the internal control system. Okay, so let's look at this. Now, what are the considerations you'll have? How do you really go about it? So as per SA 265, so that's how you need to go about it, which talks about communicating the deficiencies in internal control to TCWG. Auditor shall include in the written communication of the significant deficiencies in the internal. First, description of the deficiencies, explanation of their potential effects. Yes or no? Very, very important for TCWG to know about it. Sufficient information to enable TCWG and the management to understand the context of the communication. Again, very important. In other words, auditors should communicate material weaknesses to the management audit committee, if any, on a timely basis as well. This communication should preferably in writing through a letter of weaknesses or management letter. Okay. Important points with regard to such letter. What are those that you need to consider? First, letter lists down the areas of weaknesses in the system, offers suggestions for improvement. Okay. It should clearly indicate it discusses only weaknesses which have come to the attention of the auditor as a result of his audit, and that is examination has not been designed to determine the adequacy of internal control for the management. Letter serves as a valuable reference document for management for the purpose of revising the system and insisting on its strict implementation. Fourth, letter may also serve to minimize legal liability in the event of a major defalcation or say other loss resulting from a weakness in the internal control. Okay. Yeah. So this is it that we had for today. Thanks everyone for your time today. And we can just close the session now. Thanks so much.